All right, welcome back to the latest update for Capital Clarity. I'm Christian Maloof, and today is the 15th of April 2026. The time locally here in Sydney, Australia is 11:57 a.m. And I know that this update's a little bit later than what I usually do it in the week, but very beginning of the week, we saw a little bit of volatility in the markets, and I felt that it might be better to just see what happens in the marketplace before I throw in another update. So that is why I'm running things a little bit later this week. I've also had a couple of other financial fundamental videos drop on my YouTube channel, and I didn't want to get the two mixed up. If you haven't checked those out, jump in and check those out. We've got credit card tips and tricks on how to use a credit card to your advantage instead of a debt trap. And we've also got some interesting information or a video on compounding and how you can use compounding in your favor in your savings and investments. So definitely check those out. I'll give you a rundown of everything today and update on the trading positions that I spoke about last week. But let's start, as we always do, in the key economic news, or where we find ourselves in terms of an economic positioning in the marketplace. Once again, I just want to highlight that this is by no means financial advice. This is just me looking at the market with my lens, and this is for education and entertainment purposes. So if you are looking at some of the positions that I'm taking and wanting to join, please do your own research. Please get your own advice around that. Global economic outlook for 2026, or especially in April, is dominated by a severe energy crisis and heightened geopolitical risk stemming from the conflict going on in the Middle East. What's changed since my last update? On Tuesday last week, after I did my update on the Monday, or even the Monday night, I believe it was, we got indications of a ceasefire for 2 weeks, and that really buoyed the marketplace, and we saw some really good risk off activity. And what I mean by that is we saw the Australian dollar, the New Zealand dollar absolutely surge, which was against the position that I had in the Kiwi, which I'll cover later on in the session. And we saw gold climb a little bit, not a lot, but a little bit. We also saw oil prices coming down on that news. There was a fair bit of volatility in the market, and the indices surged, which was wonderful for investors, as you could really tell the market was looking for anything positive. And when they got the 2-week ceasefire, we did see market really buoyed by that. So that was what we saw late last week. And then over the weekend, we did see some further news that after some heavy negotiating, no deal had been made at that point in time. And so nothing further than a ceasefire exists. We saw an increase, or a gap up, in the US dollar valuation. The reason why I didn't run this session, as I commented earlier, is I wanted to see what would happen post that, and see whether we continue moving in that direction from the weekend gaps, or whether we would reverse. And so that's what I'll work through today with you. But in terms of updates, the International Monetary Fund has come out and cut its global growth predictions. So that's quite interesting. And that's obviously very much fueled by increases in costs of everything off the back of oil prices going up, and also wider inflation issues. So some interesting things out of the United States. Once again, GDP, or growth, predicted at 2.3%. That's lower than where we were at earlier in the year with anticipation of rate cuts. Those rate cuts have been stalled for the time being, and with data not looking great around inflation, I would say that those rate cuts might be held off even further. If not, we might see what's happening in Australia and some other parts in the world where interest rates are actually going up. China export growth has slowed, so GDP growth forecasts are down on China, and Europe are facing really stagnant growth of about 1.1%. So at this point, things are looking quite negative in terms of growth for the market. The Australian economy is really struggling with inflation at this point in time, and so the RBA has raised interest rates up to 4.1% to combat a last reading at 3.7% inflation. So all in all, even though the market's quite buoyed by potential peace and negotiating going on in the Middle East, there are still some really heavy weights, so to speak, in the global economy. And like I said in my last update, I'm still very worried around, even with the negotiation, a ceasefire, basically no war in our future, potentially medium short-term future, there's still going to be some significant weights on the economy around inflation issues, around oil price issues, around oil supply. And yeah, I'm very interested by what I'm seeing, in particular in the indices and stocks, where on any sort of positive news around the war, they're flying. It shows you that the market is very engaged to the bull side. However, I'm very worried about what outlook around growth and inflation in the economy looks like. And I'm not sure the market's completely digested that. It really looks very bullish at the moment, but I think that could still change. Now, I don't want to be edged to either bias, and in the past you've heard me talk about letting the market tell me what it's going to do, not sitting here and trying to forecast things. At the moment, the market's very bullish. It just seems to be in contradiction to a lot of what the economic news that's coming out is. And so it is in heavy divergence to fundamentals, so to speak. Yeah, I'm very confused about what the market's throwing up at the moment. I'll jump into the charts with that all being said. And we will start with oil because we always start with oil. We have been recently. And funnily enough, off the back of all the good news coming out around the war and negotiating and ceasefire, we've seen this area of supply that I'd spoken about in prior sessions at 117.32 really hold. And we've seen some significant downside in oil over the 2 weeks. And we've seen further downside, even with the gap up early in the week, down to some demand here at about $89 a barrel. And we're seeing that demand at this point in time hold. But I made a comment last week after we closed heavily above that 100 mark that 100 might become support, and 100 didn't become support. The second we got that positive news out of the Middle East, we saw oil prices really push down heavily. So what it tells me is that 117 a barrel, the market sees that as incredibly expensive and doesn't want to stay up there if it can avoid it. And on any good news comes down heavily from that level. We've seen that happen twice now. But it's also telling me that 100 resistance level hasn't held as support. So the market doesn't want oil above $100. I can see that in price action. But depending on where we go from where we're at the moment, that 89, between 89 and 82 level, I think should still be heavy support. And at the moment it's looking that way, but further good news around negotiations in the Middle East could see that break. So a lot to play out, but at the moment, oil is definitely holding under 100 a barrel. We are sitting at a comfortable sort of $89, $90 a barrel on the futures chart. So let's keep our eye on that and see what happens. And the next support area, or former resistance turn support area, would be down at the sort of $78 mark. So if we hold the 82 area, then we probably continue bullish based on what I'm seeing in price action, definitely what I'm presuming around supply limitations. But if we do break that 82, really next area is 78. So we could see a real significant drop in price. And that would help things. That would help things around forecasted inflation. That would help things around cost of everything. So very mixed picture at the moment in the markets, and thus is why I am a little confused. I wouldn't be taking any trades on oil anytime soon. Just far too volatile and uncertain, because there's still a lot of potential for upside, but there's also potential for downside too. And the market's showing us that on any good news, it wants to come down. Indices, you can see some really strong bullish activity starting on the 30th of March and now really coming right up back to close to all-time highs here on the 15th of April. So market really wants to be bullish. If we look at the last 2-3 weeks, we've got some really bullish movement. And that was even, if we even rewind 3 weeks ago, we still had a lot of uncertainty around the war. And we saw our low put in. A low was put in at 6345 on the S&P futures. And since then, we've been really surging higher. Really crazy considering what's going on in the world, that we're surging so much higher. But it does show you the market wants to be very bullish on anything stock related. I have commented on this channel that seasonality doesn't look favorable from next week onwards. Midterm election cycle seasonality actually looks fairly bearish between late April into October this year. So seasonality is telling me that things historically haven't gone very well. And that was what I was playing on in looking at this area here, I'm thinking over these weeks, we're getting a lot of distribution activity going on between two levels, this level here in resistance and this level here in support. At this point, we haven't moved above that. I want to point that out, but price action at the moment is telling me we do. That doesn't mean seasonality is wrong. We saw seasonality say we were going to get a bit of upside in April through to late April. We have seen that upside. We've seen massive upside. Will we get the downside forecast though? The data's saying that we've got an annualized return through that period of minus 10.69%. We've had 12 loss years and 12 gain years, and that's interesting. But with the loss years being far bigger average of minus 16.82 to the wins of 8.95. So interesting times there on that. Now, once again, does that say with absolute certainty that this is what's going to happen? No, absolutely not. Seasonality just gives us a guideline of what's happened in the past. But 18th of April is our indicator there of things stalling, and the 30th of September is our indicator there of the reversals. Just interesting data to have a look at. Where does that leave us? Looking at the chart, we've just come back up to all-time highs, which is traditionally going to be an area of resistance just above the $7,000 mark on the index for the S&P. Where do we go from here? Do we close above and hit all-time highs? Or is this the start of what seasonality is telling us is going to be somewhere between a 15 and 25% drop? And the area that I targeted in my original analysis was down here at this demand level at 5306, which would have been something along the lines of a 20% drop. Will that happen? Once again, it may not, but seasonality is telling us we should get some sort of drop. So I will keep my eyes peeled on the charts. Would I be shorting? No, I wouldn't be shorting. We don't have supply to short. We've got some resistance there, but we've got no supply. So there's no short to be had at this point in time. If we saw a drop down from these levels and supply made on the daily chart, I would consider jumping back in on a short based on my thesis. But at the moment, the market's telling us it wants to be bullish and there is no supply to be had. So there's no shorting going on. If anything, based on what you're seeing on the technical side, there's a long opportunity, and that long opportunity I see here down here at the 6663 area with the heightened costs we've had in energy. We've got oil prices still elevated. Whilst oil prices remain above $80 a barrel, costs are still significantly higher than what they have been for transportation, for services, for everything. Wouldn't be bearish if we've got no supply and we've had really bullish movement, but I probably would also be very hesitant around being bullish with what the economy has to face over the coming few months, even if the war is ended. So, you might get a brief resurgence with the war being ended or negotiations happening, but then I think reality kicks in around the economic backdrop that we'll find ourselves in post that. Real long explanation there, but I wanted to be pretty clear around where I was thinking and why I'm confused, because we've just got a lot of contradictions going on at this point in time. To the US dollar chart, and as you can see here, if I start on the weekly chart, we've been in a range, as you can see, no lower highs or lower lows or higher highs or higher lows. We're just consolidating in a range. It's really given us no key signal around what's going to happen. That being that sort of area to boss to beat, so to speak. We didn't beat it again. We've come back down. We made a massive gap on our way, and so we've got a gap here to fill, and we've now reached an area of daily and weekly support. If I look at the weekly chart on the left hand side, we're in a weekly zone of demand, and it's a daily zone as well. So we have reacted off that slightly last night. I wouldn't say by any means it's a big bounce off, and we do still have a gap here to fill. So I'm keeping my eye on that, and for the moment I think we'll stay in this range. We do have a gap to fill above, so I'm not as bullish on the US dollar as I was a couple of weeks back. At the moment, I don't think the market's got any idea where it should be and where the euro should be. So I think we're going to stay range bound for the next little while, albeit I definitely think the path upwards looks clearer for the USD based on that demand and based on the gap above for the moment. But that's by no means a long-term play. And if I look at the euro, once again, we've hit a very large sort of daily zone. We're not far away, and a weekly zone really. I've got the weekly zone marked here on this hammer candle at the moment. But look, I think the zone can go a bit further down, and so the gap, we've actually filled the gap here on the euro. We haven't filled the gap on the USD chart that we just looked at. That'll be interesting to see if we're going to go a little bit higher on the euro, or whether this daily demand into a level on level daily, and probably up to a weekly supply level across those two charts. That I think we've been range bound for a while, and I think we'll continue to be range bound. I don't think the market knows either way whether it wants to be bullish USD or bearish USD, so we're going to stay range bound for the next little while. So not a lot setting up there. You could have a trade off these areas, obviously shorting euro and longing USD. It's just so news dependent at the moment. Where there is some opportunities from what I can see in structure is the Australian dollar and the New Zealand dollar. I'll start on the Australian just because fundamentally it's the most bearish, but I've been looking at the COT data for the Australian dollar for quite some time, and we have spoken about it prior that we've got some pretty heavy resistance between the 7.1 and the 7.2 area on the Aussie dollar chart. I've had that marked out in the past and we haven't broken it. We did come down from it. We pushed back up to it. We are in a pretty heavy uptrend of late on the Aussie dollar, and there's no reason to say that structure has been broken. However, when I'm looking at COT positioning has moved into a very bearish framework. And what I mean by that is the commercial positioning is at 5-year lows, saying that they're shorting basically heavily the Australian dollar as a hedge because they think it's overpriced. Our retail market are going heavy long because obviously it has been in such a strong uptrend. And our non-commercials are just showing signs of rolling over. So non-commercials have been very long as well and have been buying long positions from the commercials. However, over the last week, we've seen a little bit of a change there. And if we get a couple of weeks of divergence, that will be a key sign to me to short. We are in an area of created supply. We've got old supply there, but we've also got newly created supply on the daily, as you can see just in this little area here. And if you look at the larger weekly time frame, we are back in an area of supply, an area that we've come down from before. We're on the chart looking at very overvalued, and we've got seasonality that's bearish. So when you look at all those pictures from a fundamental perspective, it's actually showing me, and on Edge Finder as well, I've got Edge Finder data reading a little bit more bearish on the Aussie dollar than what we have had recently. I think we're at a -1 score from memory, and that's been as high as sort of 7 or 8 in the last few weeks. So I just think all signs are saying here that we might get very well a double top on the Aussie and a push down based on what we're seeing. And when I say double top, we've got a top here, and we've got an area up here that we're moving back up. If that area rejects and we come down, that will be a double top formed. I would like to see non-commercials who have been fueling the bulk of this uptrend more recently. I'd like to see them rolling over before I took a position. But for the moment, there's a real opportunity there to short the Aussie dollar if we see next week another COT reading with position shedding. So I'll give you more on that down the track, but something just to keep an eye on. And then also you've got the Kiwi that I had shorted earlier. So we did have an area here that I shorted, and I might actually just break that down here for you to give you an update on that trade. 4-hourly chart. This was my zone just here. I'll just break that down. We came up, we touched it, we pushed down really heavily. And this is where I gave my update, actually, my last update last Monday, and we were significantly in profit. Unfortunately, from there, we got the ceasefire news. Unfortunately for the trade, we got a ceasefire news and we zipped back up. And so I was stopped out at break even on that trade. Unfortunately, it was significantly in profit. It was about 2 to 3 hours in profit at that point. So that was a bit of a shame for the trade, not a shame for world news, great news for world news, but a shame for the trade. So we got stopped out. We have now come right up to another area of supply, quite a strong daily area of supply. We saw a really good move down from this area last time it was up there, and we have touched that area. Full disclosure, I do have a trade on the daily. We're in a very strong position, and the Aussie dollar obviously looks fairly weak with COT reading. So quite neutral reading on COT for the New Zealand dollar. Nothing huge to write home about, albeit we are very negative on the non-commercial side in terms of net positioning. Yeah, I'm still more, I think there's weakness in the Aussie and the New Zealand more long term. And so I have backed that with a position. And at the moment we are moving down a little bit, not a huge way, but we've had some good price action from that zone. So hopefully we can get a little bit more of a reaction and we'll have a winning trade there, but I'll keep you updated. And the last one I just wanted to show you from last week was a trade that I had spoken about for the Kiwi yen. I had a zone that I thought was quite healthy at an area of resistance. And on that positive news of the ceasefire, we saw a real big bounce in the Kiwi. And traditionally, the yen is a safe haven currency. So that wasn't a winning trade. That was a losing trade. In hindsight, and speaking with my mentor the other day, that zone wasn't a great zone to take, just in terms of location. So we've got an area up here that would have been a lot better to take, which is where we're at now, interestingly enough, because we were really in the middle of when we had the initial move down from this level up here, this was really only a midpoint of that level. If you look at the weekly chart, we're still very bullish, New Zealand versus JPY. So in hindsight, Probably not an amazing trade to take. News definitely didn't help my cause, even though we had some reasonable edge finder readings at time of placement of trade. Those edge finder readings have understandably, based on our environment, changed significantly. I'm in a position now where that trade didn't work out. I just think it's too volatile and there's a better opportunity with the Kiwi moving on against the USD. So that's where I'm placed at the moment, but no real other trades on the go. It's just a really tough time to place anything because there's not much of an edge there because it's so uncertain. So I think there could be a really good Aussie dollar trade short in the very near future, provided non-commercials show me some further movement down in terms of net positioning. So that's my update. I'm sorry about being such a long update today. Very conflicting pictures going on at the moment, so you want to be careful. Cheers.